Welcome back. Stocks are rallying, trying for their first positive week of the new year. And the Mag 7 is leading the charge today, up about 2%. My next guests are bullish on some of the big cap tech names, despite the risk posed by the Trump tariffs. Joining me now, Tim Seymour, Seymour Asset Management, around the desk here. Tim, it's great to have you.
Great to be here, Kelly.
Let's start. I don't know. Should we talk what could happen Monday? Should we talk the tech setup? How much do those two dovetail or not dovetail?
I think they're important. Obviously, we've seen the tech community rally around President Trump, and the dynamic for the sector is one in a higher rate environment. These are companies that have a higher growth. I think there's a more defensible argument for at least half of those Mag 7s on valuation to, even in an elevated environment.
They're probably not the first place to think that tariffs are going to have an impact, right?
Correct.
Where is the first place to think about the tariff impact?
I think it's the consumer sector. I think if you look at consumer products and if you look at some parts of light industrial, but housewares, these are some of the sectors that you've seen even some front running, right? These are the reports we're getting out of apparel, places where I think, think about where the source is of a lot of these subsectors. So, ultimately, the impact of tariffs to me is a function of many different things. There's been a lot of very big headlines. Clearly, in the past, you would have seen tariff hikes come after tax cuts.
Exactly.
So
I think that's important.
The background here is going to be kind of the opposite.
Right.
I think
tariffs are definitely coming, and we don't know if hopefully taxes won't go up. Really.
I don't think they're going up, but I'm not sure they're going down. And so that's part of the support here. And I think we've seen the impact. Everyone can look back and look at the industrial landscape after significant tariffs against China in 2018 into 19, what that meant for PMIs, what that meant for manufacturing. So it's a case where I think we really need to see when the rubber hits the road here. I would argue it's going to be a drag on the economy, whether it's the World Bank, whether it's the IMF. They've all told you what the drag on global growth is coming from even just a 10% tariff across the board. Dollar strength is mitigating, no question. And we've had our Treasury Secretary-elect really point out the strength or the importance of the strong dollar. I think the dollar will remain strong. I think, if anything, you could see deval around the world as an elixir to an issue. Make your products cheaper if your currency is cheaper.
No, I'm glad that you can hear and kind of talk about that. This is one of the more outsized moves we've seen. It's not just the scope of the move. It's up 10% or so the last couple months. We're at levels that we really haven't been at except for a couple times since the 1980s. I don't know if that affects how you trade U.S. stocks. Some people said, well, isn't that a headwind then for the S&P? They do a lot of, international revenues. Well, maybe on the margin.
I think you think about this, and I run an international ETF, IDEVO, and if I think about a Siemens or an SAP or companies like this, I think they benefit. I actually think they become more competitive and more interesting. I think about
look at the German stock market, which is at basically all-time highs on the back of some of this current, like the euro looks like it's heading below parity any day now.
And that's it. And if you look at even the broadening of the market away from some of these tech stocks, Europe doesn't really have a lot of tech, bellwethers to invest in. So some of this broadening could be very good for Europe.
Let's end with, while that may be the case, there are a couple of places you would be looking here. What are they? What are some of the stocks that jump out to you?
Well, I want to be in the tech sector where I can feel good about the valuations. I know there's an argument here for Amazon. I think if you think about free cash flow generation at Amazon, there's an argument that this is a company that's finally able to turn that spigot on in a way that I think the world wants to see. I think AWS reacceleration kind of north of 20% is part of what I think the market is expecting. I think, believe it or not, at a valuation for Amazon, that's not terrible. PayPal is another name that I think has been a beaten down name over a couple of years, that over the last 12 months, we've had a management change. We've had real focus on products. I think you have a valuation that's very defensible, even though there's an argument about some of the existential risks around PayPal versus all the other competitors out there. I really like that one.
Any other international kind of idiosyncratic plays?
I look at some of the pharma plays across Europe, whether it's a Sanofi, a Novartis. Again, these are names in the ETF. These are names where I actually think that they are going to be very, very durable in an environment where we might be worried about global growth. They pay nice divs. The balance sheets are really, strong.
Are they in the ETF?
They are in the ETF, and again, it's about finding companies that are growing their payout levels, not necessarily those that are looking to pay back a lot. So, I think it's a case where you can find healthcare. I think the energy sector too. It was coming into 24.
Energy's oil's up 10% this year,
and yet if you look at the integrated oils, I don't think they've priced in a lot of this, and it is a function of these companies being able to pay big divs at much lower break evens. Total and Royal Dutch Shell, especially.
Then, in conclusion, does any of this that if people say this is a great place playbook. I'm going to go do some work on this. Does any of it change if we get tariff announcements next week or no?
I think with some of these big, large global multinationals, if anything, I think their positioning might be a little bit better. I think they're not seen also as the places where they're seen as strategic sectors that could be under undue influence. So I think the tariff landscape is something that's going to continue to play out. I think inflation is not my biggest concern for this market. It's really a growth scare. In other words, inflation, I think we can price in. I think that CPI number on Wednesday was great. It still had a lot of CPI inflationary components to it, but I'd be more worried as an equity investor about a growth scare. And that's really the follow-on effect from, let's see what tariffs do.
No, well said. Tim, thanks. Appreciate it.
Thanks.
As always, Tim Seymour.